Alright, what's up, everybody? Welcome back to another episode of Stonks Maxxing. Currently on day 173, so making pretty good progress. So I have this thing on the left here that kind of gives us the 1 day return of both software and hardware stocks. Also, here are the top 10 winners, top 10 losers for the week. Confluent, unfortunately, it's a position, not a big one, but it's definitely a position in my portfolio. It is down negative 18%. It's pretty rough. But we also have pretty good winners like Okta, which is the identity management software. I actually am pretty surprised it is up 11%. I guess they probably had earnings. I know they usually report on Monday, so maybe today they report earnings, or maybe sometime last week they did. But what I want to do today is I have to actually update my model so that it extends the forecast period. Previously, I had forecasted it up until 2030, but today I'm going to have to forecast all the way up until 2035. And I don't really have any great insights there, so I think I'm just going to use some of the historical numbers I had, and then that'll help hopefully be good enough. Yeah, that'll hopefully be good enough, I should say that. So this goes up until consensus estimates. All right. Percent delta. Okay, so I am slightly less, just about 1% less. Which honestly does not seem like that big of a deal. Let's just say, let's continue this at 6.5%. I mean, I think at that point it's very hard to tell like who actually knows. Okay, let's just keep it as is. Just hard code it so the market's gonna grow at 5%. Yeah. Okay, so this would need to be a world where, I think 40% maybe is a pretty good stopping point. Yeah. Oops. %. I could see that. Right. Bottom. Ooh, shoot, okay. Okay, I'm gonna need to bring all of this over. Up, down. Okay. All right, nice. It's pretty good. So we do see revenues, I guess, in the long term falling to around 11%. I do think that's actually still a bit high. Yeah, maybe 15%, 10%, 5%, 5%, I think is pretty fair. Right, get to this 44% range. That means 65% probably gross margins for someone like NVIDIA in the future. %0 growth. Maybe 3%. So at this point, yeah, I guess it's completely possible you have 0% growth. Okay, we going like that? We going like that? All right. It's Internet of Thing. Let's do a delta of 5 again, I think. It should be pretty fair. Okay. Okay. Right. Okay. I think this does make a bit more sense where 2020 So I think maybe in the long term, 1% maybe, and then so 12-month price 180. Okay. quarter. Okay, top. Do like a 2%. Delta, okay. Yeah, I'll keep this as is. So if we just leave it like this. So 56.1, get back to what we are at today. I think that's kind of the consensus, or that's what my forecast is for 2031 to 2035, okay? And then get back to this 44%. Okay, so this is where I got some feedback, and I think my professor suggested, okay, 13.89, suggested that I break up the non-interest or net interest income and expense. And terminal growth rate's at 5%. Okay, my phone's about to die, seems like. Alright. So I think the CapEx spend really needs to come down. By year 2030, we can turn it down a lot, I think, to about I guess inflation's also a big one. I'm surprised it's actually increasing, or it's, if I increase net CapEx spend, decreases my share price. Right. Should increase it. Okay. Let's see, so 18% to 16, then 14, 12%. Let's see, stable. Alright, so this is the bull case, yeah. Okay, nice. So get to about 9% of revenues in 2030. So we keep all of this the same. Percent of revenues. I think I got So long-term investments in marketable and financial securities. Okay. Just held that shit constant. Now all of this goes towards the cash flows. Oops. Okay, so I guess that's also another way to game your stock price, is to mess around with the working capital of a company. Okay, and also differentiation and cost. Yeah, Taiwanese tech company, there isn't much stock-based comp, which is pretty nice. Oh, God. Okay. Let's leave it there, honestly. So I'm also forecasting no dilution. I think like half of my time is just spent making this Excel model look pretty, I'm not gonna lie. And like there's not much to it. Okay, value. Ooh, okay, that's not good. Times this number. Percent of revenues. Okay, that's fine. Yeah, what is the dividend policy that I put here? Should be percent of net income. Yeah, 30%. So if I lower this to like 28%, barely affects it. All right, 28%, 30% dividends, net income. I feel like it's pretty fair to just hold that constant over time. And think now. Yeah, I don't know what's going on here. Outlier. Okay, let's say I do keep. So consensus margin is 58%. $181. Even then, I don't think it's enough. Still hold. So if right, okay. Oh fuck. There we go. There we go. Oh man, I forgot what numbers I had earlier. Okay. So now just do this if hold. Okay. Shift to the right. Okay, nice. Okay, no borders. Then we go all the way. Alright, I gotta go use the bathroom real quick. I'll be back in a sec. How is the stream going though? Oh, we got 0 views. Not too bad. So I've been going on for 35 minutes. Okay, it's not terrible. Need to go use the bathroom. Alright, I'm back. I'm back. Okay, let's make this clean. Top, bottom. Let's go bottom, top, top, bottom, bottom, top. Maybe there's a faster way to do this actually. Just oh shit. So this, let me just copy over. Lemon. Lemon. Wait a minute. Copy the values. All right, looks pretty good to me. Let's see, what's the width right now? If you do like 9, okay. Oh shit! All right, column width 10. Okay, yeah, I don't know why this text looks so much bigger than it actually is. Okay, there we go. So 7.2, I do think this number might be a bit too high. Especially with smartphones, 10% CAGR, it's probably a bit too much, honestly. $11. I'm gonna go 10, then 9. Seven, yeah. So you do have this, okay, 13%, 10%, 6.8, yeah. At $369 billion in revenue. I think That's not crazy work, actually. It's not completely crazy. So let's say average okay, so it grows at a 8% CAGR. Bottom, top. No border. Let's go bottom, top. All right. Yeah, okay, so this is where I think this number might be a bit much. Or it's like 85% of the entire market. Can TSMC really achieve that by 2029? Oh god, alright. Tough call to make. I think maybe 20% CAGR at the end of this is a bit much. So if you go to 15, 15, let's go like 13. Okay, so the market grows at 8.3%. I honestly don't see TSMC ever really losing its market share. So, yeah, I see. Could go 8%, like 7%. Take a look. I'm curious, actually. Foundry market forecast. I know there's projected to reach a size of 298. Non-memory IDM, OSAT. %. Okay, so yeah, Intel right here. Okay, outsourced semiconductor assembly and test sector. Amcor taking on more chip on wafer on substrate orders. Okay. So maybe this could grow at 10%. $17.5 maybe. So 86 is still pretty high in 2031. 84%, 86. But it's driven off of this. Okay, so let's do 13. Maybe we could do 10 here. %. Yeah, this will help us kind of maintain our market share if the market grows at 8%. So there's a lot of inputs that will shift our valuation here, which is the hell? Alright. Not entirely sure where this is. Oh, I see. We do not want this. We want consensus estimates right here. Okay. And then we want a % delta. So slightly off on the consensus. Okay. I might add one more case, honestly, where I'm just using the consensus estimates. Oh, what the? Okay, let me actually merge and center. This looks like a different shade of red compared to that. Let me see. Oh, right, I totally forgot. It's right here. Okay, so consensus. Let's do cogs. So I think we can do data. Data validation. Allow. Okay. So then I think what we could do is we can go here and we could add a consensus section. Let's go home. All right. Okay, so for this, we actually just keep, I think, let's see. So values. Does it not go? Have to do that. All right. So we need. Percent minus. Consensus. Oh. Okay. So then we have okay, yeah, there we go. So 57.7. Oh, instead of hard coding it, maybe you can just do consensus estimates. All right. So gross margin, and then we'll just do consensus. Yeah, I don't know why I made it that much more convoluted. I feel like it didn't really need to be. Let's see. Why does it keep going all the way down? Oh, I see. Okay. I'm just gonna do 58.2%, 57.7%. 57.2%, and then 56.2%. Then gross margin, we'll just grab from our income statement here. Okay. So minus, there we go. And then let's just keep it constant. Yeah, I'd imagine. All right. So let's see what happens if we choose the consensus. Wait a minute. It goes down? Oh no, it goes up, goes up. Okay. Alright. So consensus, that would mean our margin is 55, okay, to 56% by, I'll call that the equilibrium. We're still down on, yeah, so we're still a bit off on R&D and our OpEx. So I guess we're a bit off there, yeah. Closer to consensus. It's difficult because we have this revenue breakdown, so it's difficult to kind of meet consensus exactly to get to their number. I'd say we're pretty close in terms of revenue. Just a few percentage points off. Not more than 1% point off. Okay. So I think from a numbers perspective, we're getting pretty good here. Let's see. Yeah, Confluent getting crushed as usual, unfortunately. AMD's up 1.6%. It's pretty impressive. All right, so I think now it's probably time to shift gears. Oh shit. And start working on this. So net interest income is actually income versus expense on a net basis. They may have a description of their, may also help. So I'll do non-cash investments instead. I think I do this as a percent of percent of debts. We'll do non-cash investments. Okay, and then we'll do core balance sheets, operating metrics. I'll add a section for balance sheet metrics. Okay. Change this. Change this to white for now, and then, oh, nice. It's close, but not close enough. Let's see. All right, I'll choose this, or maybe this. It kind of looks like this one. Let's see. Okay, I'd say that's pretty damn close. But what we can do is we'll do non-cash investments. And we'll add investments in marketable financial instruments, long-term investments. The 20F, okay. Let's take a look. TSMC annual report. Page F 73. It's about 3 million shares purchased. Okay, so they do a bit of share buybacks. I think last time I streamed, I pretty much said that share buybacks were non-existent, but might not be the case. So I'm not entirely sure where this is talking about. Maybe it's all the way down. Okay, government grants. So government grants is actually something I totally did not even include. United States, Germany. $75 billion. %25 investment grant for qualified investments. Okay, interest income. Cash and cash equivalents, interest expense, corporate bonds, liabilities, bank loans. So majority of it does come from their corporate bonds here. Okay, maybe I'll spend the time. That's fine. So interest accounts. Do interest income and interest expense. And I'll just attribute all of this capitalized interest under PP&E, so they capitalize it. All right. Interesting. So it doesn't really come out as an expense, but I feel like it does get paid out, no? Like it's definitely a cash flow you need to pay your bond investors. So okay. I guess it just gets swallowed up eventually in cash flows, in the investing cash flows, because if it increases our PP&E account, then it'll show up, in my model at least, on the CapEx spend portion of things. Yeah, fine by me. All right. So 11,750, 11,999, 10,495. I'll just do percent of debts. Oops. And then percent of, I think, cash and cash equivalents. Non-cash investments. Okay. $87,213, 60293, and 22422. Yeah, there was this, oh man, at amortized cost. Net interest income expense. I think I saw a number add up pretty much. $10,672, 48294. Yeah, 76. 718. All right. Oh. Maybe this is something we can look for. It's probably repeatable across all of these. Maybe not. Okay. Here we go. Here we go. 16189.4 9018.4 and 5708.8. Oops. Okay, interest expense 1139. 133. Fuck. 33250 2081 and then 5414. Okay. So at this point, it seems like the company wasn't capitalizing interest on their balance sheet. Seems like it was not capitalizing interest on the balance sheets. Yeah. Take a look at this. This is an interesting shampoo I found on my Instagram Reels. Alright, I gotta change real quick. Then do some sit-ups, some push-ups in between. All right. Got some new undies on. All right, so I'll do this for now. So percent non-cash investments. Debts. Yeah, it seems like a lot. It's pretty high. Alright, so it's about 1% interest expense, percent of debts. Alright, so I guess we can just average this out. Also, just take the average here. So 11%, fine with me. Get 11%. So interest income, I think what we'll do is we'll do times non-cash investments, which is constant. So yeah, and then this just be multiplied by the debts on the balance sheet. Okay, so I'm going to, I don't know if I want to delete that yet, actually. Outside border, all right. Interest expense. Not terrible. All right. Terminal growth rate of 4%. Yeah. 4.5 maybe. Okay, so I think I'm gonna end this here probably, this stream. I'm gonna go to the dining hall probably, and I might have to change these Kager numbers so that they're going off the right time period now. All right, let's just go like this. ASP, okay. Total revenue, okay, let's do okay, so a single wafer went from, what is this? Yeah, I have to do the units. So if this is in millions, this is in thousands. So I think this is going to be in thousands then. So that means a single wafer. Oh, let's see if we could do this. I guess I'm gonna have to deal with this as is, but went from about 3,000 per wafer to today it's about 6,000 per wafer, and then I think in about 10 years it's gonna double to about $13,000 per wafer. It's the average selling price, which I think is going to be mighty expensive. We'll see what happens. All right, so thank you for tuning in, and I'm going to catch you guys soon, hopefully. I'll catch you guys in the next one. Peace.